When people talk about dividend investing, most investors think of one thing: high yield, slow growth. But there's an ETF that challenges that idea completely. Instead of paying you more today, it focuses on companies that can raise dividends year after year while still delivering strong long-term capital growth. That ETF is VIG, the Vanguard Dividend Appreciation ETF. Today, VIG is the largest dividend-focused ETF in the market, with over $100 billion in assets under management. That scale tells you something important. This is not a niche strategy. It's a core holding for long-term investors and institutions. In this video, we'll break down what VIG actually is, how its dividend strategy works, why its yield is lower by design, and how its exposure to high-quality companies, including technology leaders, creates far more price potential than most dividend ETFs. This video is based on real index methodology and real market data. No hype, no bluff, just data. Without further ado, let's begin. VIG is the Vanguard Dividend Appreciation ETF. It is a U.S. equity ETF designed for investors who want dividend income and long-term capital growth. Today, VIG holds approximately 338 stocks, with a median market capitalization of about $288 billion. The portfolio is dominated by large-cap companies and has meaningful exposure to information technology at roughly 28%, alongside financials and healthcare. As of late 2025, VIG manages over $100 billion in assets, making it the largest dividend-focused ETF in the market. It is widely used as a core holding in retirement accounts and institutional portfolios. VIG tracks the S&P U.S. Dividend Growers Index. To be included in this index, a company must have increased its dividend every year for at least 10 consecutive years. Dividend initiations do not qualify. Dividend resumptions do not qualify. Only uninterrupted dividend growth is allowed. The index then applies a second filter. Eligible companies are ranked by dividend yield, and the top 25% highest yielding stocks are excluded. This rule exists to reduce exposure to yield traps, where high yields are caused by falling share prices rather than strong fundamentals. Real estate investment trusts are excluded entirely, keeping the index focused on operating companies. After selection, constituents are float-adjusted market cap weighted, with a 4% cap on any single holding. This structure allows stronger companies to grow naturally into larger positions over time. The ETF is not designed to maximize income today. It is designed to compound dividends and capital together over long investment horizons. At first glance, VIG's dividend yield looks low. Based on historical data, VIG's average dividend yield has consistently stayed between about 1.6% and 2.0% over the past decade. Across this period, the maximum yield has generally peaked near 2.1% to 2.2%, while the minimum yield has mostly remained above 1.5%. This places VIG well below traditional income-focused dividend ETFs. This is not a weakness, it is a deliberate design choice. VIG does not aim to maximize current income. Instead, it prioritizes dividend sustainability and long-term growth. One key reason is the index methodology. Companies are ranked by dividend yield, and the top 25% highest yielding stocks are excluded from the index. This systematically removes companies whose high yields are driven by falling share prices or weakening fundamentals. As a result, VIG avoids many common yield traps. Another reason for the lower yield is the type of companies VIG holds. Large technology and growth-oriented companies tend to retain a larger portion of earnings, reinvest capital internally, and operate with lower payout ratios. This keeps current yield modest, but preserves balance sheet strength and future dividend flexibility. Lower yield also means less forced cash distribution. Instead of paying out a large share of earnings today, companies inside VIG retain capital to fund earnings growth, dividend increases, and share price appreciation. For long-term investors, this improves compounding efficiency, especially during accumulation years. VIG's yield is lower by design, but that design creates a stronger foundation for rising income and higher total return over time. Dividend yield shows what you receive today. Dividend growth shows what your income can become over time. This is where VIG truly stands out. Looking at the actual payout data, VIG's annual dividend increased from just 52 cents in 2006 to nearly $3.6 in 2025. That is an increase of more than 6.7 times over the period. Even over the more recent cycle, dividend growth has remained strong. From 2016 to 2025, annual dividends rose from $1.8 to nearly $3.6, nearly doubling in less than 10 years. The long-term compounding is clearly visible in the growth rates. The dividend annual growth to 2025 has generally ranged between 7% and 9%, depending on the starting year. Despite short-term fluctuations, the long-term trend remains intact. There were challenging periods. Dividend growth slowed in 2009 and briefly turned negative during the global financial crisis. Growth also softened in 2013, but those periods were exceptions, not the rule. From 2014 onward, dividend growth became much more consistent. In several years, annual payout growth exceeded 10%, including 2021 at 15.83% and 2022 at 11.74%. Even in recent years, growth has remained solid. In 2023, dividend growth was 7.93%. In 2024, it was 5.33%. In 2025, it was 5.29%. This matters because dividend growth compounds. A lower starting yield combined with 5% to 9% long-term dividend growth can result in significantly higher income over time than a higher yield that barely grows. For investors who reinvest dividends, each increase builds on the previous one. That drives higher yield on cost, rising real income, and stronger total returns. This is why VIG works best as a long-term holding. It is not designed to maximize income in year one. It is designed to build a growing income stream over decades, supported by earnings growth and disciplined capital allocation. Dividend growth is the engine behind VIG's strategy, and over long time horizons, it often matters more than headline yield. Dividend growth alone does not explain VIG's long-term performance. The underlying companies do. Today, VIG holds approximately 338 stocks, with a median market capitalization near $288 billion. This is a portfolio dominated by large, established market leaders. The sector exposure makes this clear. Information technology represents about 28% of the portfolio, making it the largest sector allocation. Financials and healthcare follow, but technology is the key differentiator. This is unusual for a dividend ETF. Many dividend funds avoid technology because yields are low. VIG does the opposite. VIG owns companies like Broadcom, Microsoft, and Apple. These companies are not owned for high yield. They are owned because of earnings growth, pricing power, and cash flow expansion. Technology companies tend to reinvest a large portion of profits back into the business. This drives higher returns on capital, faster earnings growth, and stronger balance sheets. As earnings grow, dividends grow as a consequence. Share prices grow as a reflection of that growth. This creates a powerful combination. VIG benefits from dividend growth on the income side and multiple expansion and earnings growth on the price side. That is why VIG has historically delivered much stronger capital appreciation than traditional high-yield dividend ETFs. The market cap weighting reinforces this effect. As companies like Microsoft or Broadcom grow larger, their weight inside VIG increases naturally. The ETF systematically allows winners to compound over time. This structure explains why VIG behaves differently from income-focused dividend ETFs. It is not designed to extract cash from mature businesses. It is designed to participate in long-term business growth while maintaining dividend discipline. This is the core reason VIG has higher long-term price potential than most dividend ETFs. At first glance, VIG and SCHD may look similar. Both are dividend ETFs. Both focus on quality companies. But when you look under the hood, the overlap is actually very low. By weight, the overlap between VIG and SCHD is only about 12%, with 29 overlapping holdings. That means nearly 90% of each portfolio is allocated differently. This difference shows up clearly in sector exposure. SCHD is significantly overweight in energy, consumer staples, and communications. VIG, on the other hand, is heavily overweight in technology while being underweight in traditional income sectors. That allocation difference explains much of the performance gap. Over longer time horizons, VIG has delivered stronger returns. Over 1 year, VIG returned about 16.4%, compared to 7.1% for SCHD. Over 3 years, VIG returned about 15.3%, compared to 6.7% for SCHD. Over 5 years, VIG returned about 11.5%, compared to 8.8% for SCHD. Over 10 years, VIG returned about 13.9%, compared to 12.4% for SCHD. This is not because dividend growth is inherently better than income. It is because the underlying companies are different. When you examine the largest differences in holdings, the story becomes clear. SCHD is overweight companies like Bristol-Myers Squibb, Chevron, ConocoPhillips, Verizon, and Altria. These are mature businesses with strong cash flows, but limited long-term growth. VIG is overweight companies like Broadcom, Microsoft, Apple, Visa, and Eli Lilly. These companies combine dividend growth with earnings expansion and price appreciation. Because the overlap is small, small, returns naturally diverge. SCHD converts profits into income. VIG allows profits to compound through growth, then distributes rising dividends over time. This difference in structure explains why VIG has delivered higher long-term total return, while SCHD has delivered higher current income. They are not competing strategies. They are designed for different objectives. VIG is built for dividend investors who think long-term. It is designed for investors who want dividend income that grows, while also capturing capital appreciation over time. VIG is well suited for investors in the accumulation phase, long-term dividend growth investors, investors who want income that can keep up with inflation, and investors who do not need high cash flow today. VIG is less suitable for investors who rely on dividends for immediate income. That is where SCHD plays a different role. In a dividend-focused portfolio, SCHD and VIG work best together, not as substitutes. SCHD provides higher income today and smoother cash flow. VIG provides dividend growth and long-term price appreciation. Holding both allows investors to generate income now, grow income for the future, and reduce reliance on any single dividend strategy. Together, they create a more balanced dividend portfolio across market cycles. To summarize, SCHD monetizes cash flow, VIG compounds growth. Used together, they allow dividend investors to get paid today and grow income for tomorrow. If you found this breakdown useful, please like the video. Subscribe for more deep, data-driven ETF analysis. And let me know in the comments, are you building your dividend portfolio with SCHD, VIG, or both? Thanks for your time today. I will see you in the next one.